if you're just a normal trader, is it really worth it?
No.
Is it really? I mean, is it really worth it when you can, that's why I always kind of get trolly when I go, hey, you got to break the 9 EMA first before you can think about anything, because all the algos are written for the 9 EMA, right? So it's like, if it's really just based on what these algos are doing, then nothing else really matters. You know what I mean?
It's so fucking frustrating. Like, I have like my really, really fancy indicator, right? And like it basically tells me like, okay, like which direction do the market makers, are they incentivizing us to go, right? And so like I can basically say, like, I know it's like, oh shit, like this option is really, really cheap, right? And so we should all buy it, meaning like we should go up or whatever, right? And dude,
Theoretically.
I know, theoretically, I know exactly what the market should do in every moment, more or less. But sometimes it just like goes completely off the wall.
What are your constraints? Yeah. Well, so here's the thing: we're in an extremely abstract, esoteric, theoretical area of the market. And what are most market participants doing, though? Like, what would you say, like 80% of market participants are using as a base layer of their trading style? It's probably a moving average. I would say most people have a moving average on their chart.
Yeah.
Right. Most people are not watching order flow. Most people are not watching GEX. They're not watching option premiums, and they watch the VIX and they watch, moving average. And so you have a constraint, right? And that's total volume for the day. Okay, which is again linked and correlated to what volatility is going to be. Well, volume is really low right now in general. Okay, so the market can only do so much, and then you fall back on this situation where it's like, well, you're just constrained by market participants.
That's a really good fucking point, because it's like the problem is kind of like, yes, in an ideal world.
Exactly. Ideally, if you had enough participants in the market, theoretically, that option, everyone should be buying it because it's cheap.
Yes, exactly. Yeah.
But there's not enough participation, especially in the fact that you've got people just using a 9 EMA. They're not looking at the theoretical value of that option. And so you just don't have enough people to do the right thing. You know what I mean? To do what's supposed to happen. So you get frustrated because it's like, are these people stupid right now? Like, are you really buying SPY 432? Really? So you get frustrated, like, you're so stupid. But they're not. They're just, there's just not enough people involved. That's my thing. It's like I got really interested in this idea of breaking it down to just like, what is the average move of the day, okay, and then what is the average volume, and then just finding weird little intricacies that occur with that, because it's like you're constrained by the fact that these two things are what are measuring market participation. And if you're going to have a lot of market participation, okay, well, now we could talk volatility. But if you don't have market participation, you're going to see that RVOL go down again. And okay, well, if RVOL is going down again, well, what's going to happen? You're going to stupid melt up, because the algos are just going to buy the 9 EMA. Or basically that's what ends up happening. And then you get a little bit of a sell, and the algos come back in again with the auto bid, because there's just no sellers. There's nobody participating. Anyways, that's a digression, but it's like that realization when it came to the fact that, like, man, you can learn everything about these theoretics, and it's super helpful, but when it comes down to it, it really is just a market of the only thing that really matters is people, are they actually in the market doing stuff actively, or is it just passive stuff going on? And I don't know, that helps me a lot right now. Like right now, okay, is this week going to be next couple of days? Let's just talk about what's going to happen until CPI. Are you going to be actively trading Monday when CPI and FOMC are coming up?
Not really, man. I just have a ton of textbooks to like look through. That was what I was going to do.
Right. What is everybody else going to do? They're going to come in and they're going to buy the 9 EMA. Right?
Yeah, I mean, they'll
VIX is going to chill at 14 or 15. Big freaking whoop. Buy the dip. That's basically what it comes down to, in my opinion, until CPI. Because who's going to be out here selling or buying in a big way unless they already know what CPI is? That's the only outlier, is like there's a chance that number is leaked and then some fund is in here. I mean, you got BlackRock or Vanguard, which own everything. If they come in here and start selling stuff, well, then we can start talking. But, unless the number is leaked, there's nothing's going to happen.
Well, that's another thing that's kind of funny, right? It's that, like, there's this weird, right? So, like, market depth, you're talking about participation, right? Like, market depth could be really poor in the sense that, like, so right now we're trading at whatever 4,300, and maybe the journey, and I think you tweeted this or whatever, but like the journey from 4,300 to 3,800 could happen in 2 seconds if there are no bids, and like, we don't know how many bids there are underneath the market, because all we need in order to sustain the current price is 1 per second.
Yeah, so. Well, all you need to keep price stable is nobody hitting, nobody being an aggressive buyer or seller. Okay, because that's the only thing that moves the market, is if you have an aggro buyer or seller. Because passive buyer and sellers don't do anything. They're just sitting there on their limits. So, you got to be able to take the ask out if you want it to go up, right?
Yeah.
Someone has to come in and market bid, take out the limit orders above the market, and get aggressive to move it. Well, you can only do so much of that in a day. It's constrained literally by the average volume. There's just only so much participation that occurs on average. And, so you just get these situations where it's just, you just don't have enough participation. Nobody cares. Nobody wants to do anything until something shows up again. And then you just get the squeeze, right? Like, what's happening right now in the market?
I mean, actually, you know what would be good to do, because I have not done this in a long time, is to actually look at a GEX chart again.
Yeah, okay. Well, take a look at the GEX chart and let me know your opinion on it, because it's like, what is happening right now? It's just people are just succumbing to the dealer buyback, the floor that's in the market, because all these bank puts again. And what I was thinking about is, like, I was thinking about, are we in the expiries, the last part of the term from when COVID happened? And it's like, were people buying puts for 2023, from 2020? Like buying put, not leaps, but whatever the opposite of what, a leap would be on puts.
I mean, wouldn't those have been, like, long ago died out?
Would they have, though? I don't know. I think so, but I was looking at where these OIs are on SPY and SPX, and I was like looking at these puts, and I'm just like, goodness gracious, these guys are way down there. You got OI down at like 300, 320, 350. And I'm like, you're talking about like end of days type of scenarios here, and this is what's expiring into Friday effectively. And it's like, okay, well, if that's the case, I mean, we could still fall, but I don't know. Is that what the dealers are buying back here? Is this all these puts from like literally COVID and then the bank crisis? I don't know. I was just thinking about that the other day. I was like, well, this is kind of the timing of when people would have bought like this far out as possible SPY. Like, let me just buy these 330s from as far out as I can get them.
That sounds so implausible to me, because like the puts from way back in from COVID time were like way lower, way lower, right?
Well, think about this. Yeah, well, if they were way lower, but they were super expensive too. I just remember trading it, and I just remember thinking, like, you would have puts that were 200 points down in SPX worth $2, $3, sometimes $5 on 200 points down. Think about it now. If you trade SPX puts right now, where's the $5 put? Like one strike below.
Mm.
You know what I mean? And so it's like people were sitting in those. They didn't all sell them, and they were buying those things for ridiculous IVs. And I imagine that every time they try to buy a weekly, they just go, well, let me buy the next one. Let me buy, let me get out a little bit further on the structure. And the only place you could end up buying, if you're ever part of a squeeze, if you ever saw Tesla's gamma squeeze, if you were trading that, I don't know if you were,
No.
but the only, you had Tesla's trading 1100 and you had the 2000s trading for $2. And that was the highest strike that you could go. So imagine, COVID, we're cratering every day, and you want to get into some SPX puts. Well, you probably got to go out pretty far, I would think, to buy them with any kind of deal, because you're not buying the weekly. You're not buying 200 points down at $5 unless you're an idiot. Okay. And so you go to 2023, you go buy out as far as you can. And you go, okay, well, if it continues going down, I'm just going to sit in these. And I got them as cheap as I possibly could. And then what happens? You melt up forever. Well, you're not going to sell them. You're going to sell them. I mean, who cares? They died already. You just sit in them. I don't know. That was just my thinking on that, because it's me.
It's like one of those conspiracy theories. It's just is it plausible enough.
Is it just on the? It's a tail theory, right?
A tail theory. Yeah, that's a good way to put it.
Well, I don't know. It's because I've been trading for this long. It's like I was thinking back, like, gosh, we're sitting here literally at the end of the furthest out strikes that you could buy from COVID was around this time. And so it's just interesting that, we got so much OI expiring now. Is it all just from the banking crisis? People just buying hedges for the banking crisis? Possibly, probably. But it's also at the tail end of that, of as far out as you could buy from COVID too. So I don't know if there's still some of that left over. And if that's the case, think about the implications of the hedges and puts from COVID coming off the books finally. Which is just fascinating to me to think about, because Jem talks about this coalescing of liquidity drying up, rates going back up, sticky inflation, and then you got this OPEX hitting right into, effectively we've already had the summer melt up that we usually have. And so it's like we pulled that forward in a way. And is summer going to be more like what fall is every year? Is the seasonality kind of shifted a little bit? That's sort of the way I'm leaning towards right now, is, because, the liquidity is going to dry up, and you've got all these puts rolling off, and maybe even some COVID puts rolling off. Banking crisis ones are coming off. COVID ones are coming off. People are super bullish right now.
When is so if you buy fucking like leap puts or whatever, what's that big ass expiry?
That's a great question. I need to look into it, because I literally just started thinking about this yesterday, and
let's do it.
Yeah, I'm hopefully I'm not getting people all worked up on a major crash coming up, but I'm pretty sure the stars are literally aligned. For a giant rug. I don't know if it's going to be a crash, but I think a rug is in order.
Man.
It's going to be kind of hard to find it. It's equity leaps. So leaps are long-term calls, because it has asset appreciation in there as part of the acronym. But I don't know what put leaps are called, to be honest with you.
There's like okay, long-term anticipation securities. Oh yeah, you're right. That is a completely different thing.
Mm-hmm. But buying puts that far out, it's just literally a long-term hedge. And I remember trading with a bunch of guys, and that's all they would do, is they would buy these when they got a chance to buy some cheap puts further out. They would just do it as insurance. It wasn't like they hoped they hit. It was like, if they hit, okay, fine, I'm glad I bought it. But if not, I'm super long. So I don't really care.
Okay, is this completely wrong? But it seems like September 11th, maybe? Or is this something else? You see what I'm looking at here?
Yeah. Does that say 2026?
This is, yeah, that says 2026. I don't know what the fuck that's about. January.
Well, so so
here, dude. It's equity leaps expire in December, January, and June.
January and June. Okay, so that's June, right? Okay, so
okay.
Well, okay, so if we could time travel back to 2020, what was the furthest strikeout that you could buy put-wise, option-wise, really? And I remember seeing at least January 2023s when I was looking out, because I was looking at them too, like, man, how much are puts? Like, how much is the SPY 300 here? How much is the SPY 200 put? You know, as far out as I can go, and I would just look at the pricing. And yeah, I mean, I'm sure you could have bought the June 2023s in probably middle of 2020, towards the end of 2020. You could have been buying those, and they were already kind of melted up pretty well by then. You know, at that point in time, you're starting to hit those areas on the chart where it's like, okay, we could probably see a pullback here again, and obviously we didn't.
I'm kind of liking this theory now, man.
What if I'm onto something? I don't even know, but I think it's interesting that you know, if you've traded long enough, then you're going, man, is this really? Are we running into the zone where this time period? But it could be. It doesn't really matter because all that really matters is that for the most part, all the puts are rolling off here, and people are super bullish.
Well, that's the next thing I want to say. I mean, I was just, because of curiosity, I was looking at this SPX chart, and they do some weird sort of synthesis of like gamma exposure, but also with like, I don't know, so that you can see everything. Anyway, in any case,
is that the notional? Essentially, they're talking about. I see it's gex per point there. So is that just notional values?
Oh man, net gex per notional dollar per strike in thousands of dollars.
Yeah, there you go. So it's saying you got the notionals over there.
But I mean, we're at 4,300, which is right here, and we have this just massive 4,400 strike.
Mm-hmm.
This, I mean, to me, if I were looking at this chart, this does not look super bullish. It looks like they ran too far ahead, and now all of a sudden they're in calls that are way too intense for what we're gonna do. No,
everybody's in. I mean, it matches what the sentiment is, in my opinion. People are bullish right now, and you know, I'm feeling it too. Like I look at myself and I go, man, can anything take this market down now? I mean, what is going to come out of left field that takes it down? And if it was anything, you know, what's the point in buying hedges here?
Yeah,
because nothing can hurt us. And so it's that feeling that everybody feels too. And you just go, shoot, let me just buy some calls, man, and just ride the wave. And it can keep going. I mean, but this is the reverse of what this like skew that you see here with these lines. This is like the reverse of what you've seen in the skew on SPX for the last, like, I don't know, 8 months or so.
Yeah, exactly. That's exactly what I'm thinking. It just so
it's finally starting to flip, where people are going to be you know, just not hedged, because, you know, what's the point? Why waste your money?
I think so. I'm trying to pull up the actual expiry, like that we're looking at. That what was it again? The 16th, I think.
Yeah, the 16th was the SPX AMs expiring, which is fascinating. It's 35% of the OI over 98 days. So you're talking about quite a few expiries, and that is a hefty portion. And there's not even a close second, really.
Yeah, and like
that was the other thing.
Tux was so dismissive of that one, and I didn't really understand what the hell he was tweeting about, to be honest.
Oh, my man Tux, he's been very dismissive of my theories lately, but it's fine. It doesn't really matter because it's just like it's all a probability game, anyways. But you know, people think the quarterlies matter more. That's the thing. And, you know, it could be that the quarterlies matter more. I don't see why they matter more, because on a magnitude basis, I think 35% of the OI matters more. But that's just me. You know, it could be that the quarterlies are driving everything. It's very possible. I think that they'll have their time in
dude.
I think the quarterlies will matter in the week of the quarterly expiration, but I think in the week of 35% OI expiring, I think that matters more.
Dude, I think it fucking matters. I mean, look at this. So I just did the this is the chart until the 16th, like through from basically just this week, SPXA. First of all, like compare. Actually, you know what? I'll do it like this so you can see. Oh, I guess you can't. I can't do that. Shit. Sorry. Okay. Anyway, you can see this though, right? And like the top one is at like what 600 million ish. And then I look over here, and the top one is at 800 million-ish, which is 4,400, a little more than 800. So basically, like we're looking here, this is through 2027, like all the SPXA, but basically all of that, at least in DEX terms, is like literally this week. And then it's not focused on 4,400, it's focused on 4,350, but that's still 50 points out of the money from where we currently are.
And the JPM caller everybody cares about is at 43.20. That would be the long call, I believe, at 43.20. So you got the I think the JPM call. I need to validate that. I don't care too much about it, but I think if it's a long call, that would be extremely bearish into the expiration, in my opinion.
Yeah, 100%. I mean, that's probably what we're seeing. 43.20. It's got to be right here. Yeah. So
you could overshoot it a little bit, but I think that's going to pull the market back down and then send it even lower, as you wouldn't have the buy the dips in the market anymore, because it would just be the dealers would be working against you.
Well, I mean, you were just talking about this, right? Like, oh, hey, there's not a lot of liquidity out there right now. It's the summer, nothing's happening, and then all of a sudden you have this like injection of forced sell because there are options that are coming off that were placed back at a time when there was more liquidity.
Exactly. So I think the key would be to find that level or levels or zone that would cause the market to go volatile instead of sitting non-volatile where it's like above all the volatility triggers and stuff. So you'd find that key level where the market makers now are selling with the market, and that's where you would probably get some big washouts.
Yeah, I mean, I wouldn't be surprised. I was thinking exactly what you just said, where it's like, I wouldn't be surprised if this week we basically, actually even going into isn't JPOW this week too? Jesus.
Yeah, it's CPI Tuesday, FOMC Wednesday, and
then my God.
Quad Witch Friday, and then you got Vic S next Wednesday, and then you have quarterly OPEX. So I believe, I think that's basically how it goes. You got quarterly OPEX so it's going to be a week. Then you got quarterly OPEX on the 30th.
Yeah, I mean, I could see that then, because it's like
super interesting situation here.
I remember that one time. This kind of reminds me of that one time where like JPOW was speaking in front of Congress, and he spoke like 3 days in a row or something, and so the vol just wouldn't die.
Yeah. When was that? I don't remember when he was just nailing the market every single day, and I saw people like, please just make him stop talking.
And now that the market's going up, everyone's like, hey, stop! Like every single thing they say is,
it's interesting, man. I was thinking about, I was kind of again theorizing a little bit about how they're able to keep this market up, and I don't think it's it's the bullish narrative, probably short covering, that kind of thing. But then they have this situation where they got the Fed blackout, where no federales come out and start and jaw the market down. So it's kind of like you got this vacuum here where it's like it just suppresses the VIX so much because there's no Barker to come out and sell it down off a level, right? And cause a little volatility to come back in. And so are they just kicking the can down the road for once the Feds start coming out and talking again? They're it's like this little window where they just go, hey, Literally nothing's going to happen. I'm not going to talk the market down. You don't really have any big economic data. And so you had Friday where there was literally nothing on the counter.
But that's
and you
something...
had Fed blackout, okay, and the market barely went up. I was thinking to myself, like, that's why I said 43.52, because I was like, there's literally nothing in the market right now to take the market down. Why wouldn't it just go to 43.52 or just go up, at least break the JPM collar? It couldn't even go up with nothing. So there's no vol suppression left. You know what I mean? Like the VIX is probably bottomed out. If anything, doesn't mean SPX doesn't go up, but if they couldn't even get the market to go down when there was no economic data or nothing, and they couldn't get it to go up, then I don't see where the VIX is going anywhere now at this point. I'm going lower. I don't know. It's just my theorizing here about those like windows and stuff.
Also, just like having all these fucking events in a row, it's gonna be
right. So
from a vol perspective, it's just hard.
We had nothing. Fed blackout. We had zero economic data on a Friday into a weekend, and then you got just the biggest vol events for equities that you can find are all stacked in a row for the next 3 weeks.
I mean, this goes back to the volume issue that you were discussing, right? It's like that's kind of how vol works, where all of a sudden it's kind of like vol is kind of like the crowded trade, right? Where it's like everyone's going to be stepping in to deal with whatever the fuck's going on, and like whether it's bullish or bearish, it's just going to increase vol. Over and over and over.
That's where I say I think the VIX had bottomed, because at least I'm pretty sure about that much. Whether or not SPX is going to continue going up, I think it does. In some sense, but I think at least vol has bottomed, because how much lower on volume can you get? How much lower on the VIX can you go? It just doesn't make any sense. I think everybody that's going to be squeezed out of vol from the long side has probably been squeezed. And I'm seeing FinTwit now. I'm seeing a lot of options sellers coming in. So you almost got like, now, I wouldn't call them theta, but I guess it's like theta twit is coming out of the woodwork. Okay, so you had FinTwit, which is sort of everything. It's really just like futures and degens. And then you got dividend twit, which people are talking about their dividend stocks every day. Oh my gosh, I bought like one share of Coca-Cola or something, brick by brick. Okay, good for you. Okay, talk to me in 30 years. And so you got div twit, and then you've got theta twit. I don't know what to call them, but they're coming out of the woodwork talking about their option selling portfolios. I've never seen this before, and I've been around FinTwit for a long time. I haven't seen these guys out of the woodwork like this. So in my opinion, I was just going, wow, everybody's in the short vol trade now because they're just selling premiums, and it's working. I'm not hating on them. They've been doing it for a long time and it's been working, but now they're out talking about it.
Yeah.
It's kind of like when you see the Barron's article front cover talking about this bull has legs, and I'm just going, wow, that's like being on the Madden cover.
What is wrong with them? Like,
that's like, does that? You know the Madden curse, right? Like if you're on the Madden cover, you're basically you might as well just quit football because you're screwed. So why that curse worked like that? It's the same thing in the market, man. Once Kramer is in your trade, I mean, it's basically over.
Yeah.
Anyways, that's sort of my theory. I'm just going, oh my gosh. And my mom was talking about buying SPY the other day. Okay, she didn't even. My poor mother. She didn't even know it was the S&P 500, but she saw an ad to buy SPY. And so she's like, "Oh, is that a good investment?" I'm like, "Oh gosh, oh no." This has got to be the end, right?
Dude, my dad actually put some pressure on me a little bit. I mean, not that much, but because like I manage some family money, and he's like, "Hey, so are we gonna get back into the market or what?" And I was just like,
there you go, man. There it is.
That's where I got that, because I basically told him, like, on the phone, I was like, you know what, we're value investors, man. That's what we're gonna do.
Yeah, we're just looking for value, man. We're like, you ever seen The Big Short? We're looking for extreme value. We're not trying to chase, the FOMO and everything. Was he trying to get you to buy AI?
Yeah, I mean, he was asking about it a little bit. Well, the funny thing was that I was selling puts on Nvidia back in October when it was trading $110.
I remember that.
Um,
And you were selling them at, I think you were selling them at like 260, 270 too, weren't you?
no. I was selling.
Oh, you were selling. I thought you were selling calls. Were you? I thought you were selling calls. In the money calls.
More recently, I sold calls in Nvidia. Yeah.
That's right. Yeah.
But that was. But it was. I mean, not aux style. Like I didn't stay in them. It's like basically right. I was like, okay, I think we're gonna go back down. I'd sell a call. It wouldn't work. I'd buy it. I'd make like $50 on it. So I'd buy it back and be like, okay, this didn't go the way that I thought it was gonna go. And like, that attitude kind of saved me from being involved in the whole squeeze.
Yeah. Well, that's good, man. I mean,
well, I think if you're getting short, and I mean, this is something that I was kind of thinking about lately. It's like if you're getting short, then you kind of have to be aware that it's very different. It's like a very different activity than getting long.
For sure it is, and it's Druckenmiller was talking about that the other day. I don't know if you saw his little blurb recently.
I keep seeing that pop up on Twitter, but I haven't clicked it.
You need to click it and read it because he's talking about how, he likes being short. He likes to short the market, but, he's basically, I guess at one point with the Soros fund in 99, he shorted $200 million of stock on 12 companies.
Yeah.
And covered like 30 days later at a loss of $600 million.
Wow.
And all 12 of those companies went bankrupt at some point.
Oh my God.
So he was talking about how what a different animal it is to try and short, especially into like the crazy FOMO chasing, like what you saw with Nvidia. I mean, Nvidia is not worth what it is priced at, in my opinion. And
well,
but it doesn't matter.
It's one of those things where the way I was describing it to my cousin is like they would have to increase their annual revenues by like 20% or like profit even by 20% every year for the next 20 years or something in order to be worth what they're currently valued at.
Right. But, it's like what he says, what stuck with me is like, as soon as you try to short the market, you introduce market timing. Okay. That's the variable you introduce because otherwise being long has no, you're just investing. You don't have a market timing.
Yeah.
For the most part. Okay.
Yeah.
And then I heard another big trader one time say this. He said, if I ever gamble, I always try to gamble by leaning bullish. And, because you have a natural edge there. So by just being long. And so that kind of, puts a little perspective in, I try to feed that into my little trading system. It's like, okay, I just want to try and lean bullish most of the time. If I'm going to, get into trades. If it's bullish, I want to be a little bit more leveraged. I want to be a little bit longer. And then you're trying to lean short, you got to be super careful and probably take a lot of risk off.
Yeah.
And be ready to cut your loss quickly.
Well, I noticed that with vol because like I have like tools that monitor vol, right? And like even intraday. And the mean reverting characteristics of vol are literally the same as the positive drift that's inherent.
Interesting. That's interesting.
So
okay.
if you build algos just based off of vol, they will inherently have that positive bias.
Yeah, that makes sense. That makes a lot of sense.